Hi, everyone. So, welcome to the session today on financial management as we look at some of the key issues that we have to be mindful of to put ourselves in the position to pass the examination. It's going to be an intense 3-hour masterclass focusing on the key issues that we are going to be seeing in the exam hall when it comes to financial management, providing you with a masterpiece on the various issues that you have to understand so you can put yourself in the position to go into the exam hall and pass the examination. So let me bring up my screen quickly and let's begin our discussion on financial management. And so when it comes to the idea about financial management, a number of things we need to be mindful of. Give me a sec. Let me pull up something quickly. So when it comes to financial management, the first thing we need to be mindful of is the syllabus. Because it is always important to know what is in the syllabus so that you will be able to then position yourself to understand and know what to expect in the exam hall. So when it comes to our financial management examination, what are we expected to know? What is the examiner going to be asking us in the exam hall? It is important we know this. Then we can get goosebumps on the various things we have to know about. Now, the syllabus is divided into 8 sessions, and questions are going to be coming from each of these sessions in the exam hall. So we have the financial management environment, that is 5 marks. This is the introductory theory issues, objectives of financial management, and those things, role of financial management, the role of Bank of Ghana, those things, regulatory authorities, those fundamental issues here. Then we come to sources of finance and financing decision in the public sector. Sources of finance and financing decision. That is 15. Now, there is a little thing there because remember that now in the syllabus, the ICAG has integrated public sector. So there is also how public sector organizations raise revenue or government raises revenue. So there is public-private partnership arrangement embedded in that B aspect of the financing of sources of financing. So we look at the sources of financing for the private entities, which is the normal thing we know in the short term. We are dealing with trade receivables, bank overdrafts, short-term loan, trade payables, bank overdraft, short-term loan, short-term sources of finance. Then in the long-term sources of finance, we are dealing with equity finance and then debt finance. And then we need to calculate the cost of these finances, and that is where we're going to calculate cost of equity, cost of debt, the weighted average cost of capital, and those discussions. And we'll get into those things as we continue. But then we need to also know the issue in respect of the Islamic finance, because as part of the sources of finance, the Islamic financial instruments are also available, and we must know about them. And we'll get back into some of these things later. But then in the public sector, the government is able to get its revenue, generate its money from various sources to fund projects. Government can use taxes, it can use debt finance, it can use grants and donations, but also it can leverage the public-private partnership arrangement, and we're going to be getting into the discussion in a moment for you to get the understanding. Then we come to a 20 marks area that the examiner will be getting excited about, and that is investment appraisal techniques. And so it is important we understand the various issues when it comes to appraising of projects or appraising of investments in the public sector. So we are going to be getting excited and looking at the issues in respect of the accounting rate of return, payback period, discounted payback period, all of those issues we must understand. NPV, IRR, all those things we must know about them. Then number 4 is going to be treasury and financial risk management. So this is where we are dealing with the various issues in terms of how we can how we can manage the risk, exposure to currency, so currency risk, then interest rate risk, using the various hedging method, money market hedge, forward contracts, and then issues in respect of net off and other methods. We're going to be getting into that. Then working capital management, a very important area, 15% that the examiner is going to be bringing in the exam hall, and we must make sure we understand very well because it's a done deal. Then business valuation, 15%, because we got to value businesses, mergers and acquisition. How do we value businesses? We must get ourselves into that as well, and we're going to be looking at that. Then public sector financial management. This is where we're going to look at the PIFA, Public Expenditure and Financial Accountability Framework, and then the issue in respect of public procurement. So in financial management, those two things going to be here. PIFA, Public Expenditure and Financial Accountability Framework, and then public procurement, the various things we must understand there. Then the last one will be developing technologies in finance. So the various IT issues that we must understand when it comes to finance. So these are the things that the examiner is going to be bringing questions on, and the questions are going to be spreading across each of these areas that you are looking at in the examination. And so it is important you understand each of these areas. Now, my discussion is going to be divided into three major segments. We're going to be looking at the public sector issues in financial management first. So we're going to look at the public sector issues. That is give and take in total about 15% of your exam. Now, when I say public sector issues, I mean we will get excited to talk about public procurement, public-private partnership, and then we will talk about PIFA, the Public Expenditure and Financial Accountability Framework, and then number 3, we will talk about public procurement. So these are the 3 issues in the public sector issues in respect of financial management that we need to be mindful of. Give and take around 15% that the examiner is going to be getting excited about. So that will be my broad area of discussion. That's where I'm going to be starting the discussion from, number 1. After that, we will get into some calculation-related issues and the discussion on working capital management, which is a 15% of the syllabus as well that we need to understand. Then we may wrap up the session today on investment appraisal. So that is my goal in this presentation tonight. We'll look at 15, and then we'll look at working capital, then we'll look at investment appraisal, 20. So 20 marks here, 15 here. So give and take, we're going to be attempting to approach 50% of the syllabus, done deal, waiting for us in the exam hall, the fundamental issues that we need to understand to put ourselves in the position to go into the exam hall, write the exam with confidence, and most importantly, pass the examination. So let's begin the journey with a public sector issue, and let's come to the sources of finance in the public sector. So a lot of the discussions here, you know them in public sector accounting and finance. Because when it comes to where government gets money from, primarily, government gets money from taxes. So compulsory amounts levied on the income gain receipts of individuals and organizations. So we have direct taxes, indirect taxes. That is the primary source of revenue to the government. In addition to that, we have non-tax revenue. These are other revenues coming in from service fees, fines, penalties, forfeitures, other investment income coming in non-tax revenue. That's the second category. The third category is going to be grants and donations, because whether I like it or not, as a developing country, one of the ways or places government gets money from to finance its projects will be grants and donations. So there are certain infrastructure projects that are funded free by an international organization. It could be a multilateral grant or bilateral grant that is there. Number 4, if government is unable to raise enough taxes or get enough grants coming in, then the government will use debt finance, and that is where the government goes to borrow. It could be from IMF or World Bank, or it could be from the international money market, Eurobond, to finance projects. All of these are ways that government gets money to finance both day-to-day running activities as well as its policy and capital investment projects. But we are not going to be getting a lot of goosebumps on these 4 sources of finance. But there is another source of finance that we can undertake. For instance, government needs a lot of assets. So government needs infrastructure, property, plant, and equipment. So infrastructure, we need roads, we need schools, we need hospitals, okay, electricity, okay, energy. All these are infrastructure facilities that require significant amount of financing. And so the idea is that, yes, government can raise tax revenue, but Kwame, government can go and borrow, but that will increase the burden of government. Government can lobby for some of these things to be done, but how far can you lobby? Because there are disadvantages of over relying on government, on grants and donations to run the affairs of government. If we lobby a lot for grants and donations, then there are going to be external influences on the socio-economic policies of the government. So you can no longer be a sovereign state if everything you are doing, another country, another external organization has to fund it. Then in that case, they're going to tell you, do A, B, C. Because if you don't do it, forget it. We are not going to give you any grants again. So you cannot rely more on grants to fund the day-to-day activities of the government. So what then do we do? It's possible we bring in the private sector to help, assist in providing some of these infrastructure facilities. So the process of bringing in the private sector to come and finance a capital project is what is referred to as the public-private partnership arrangement. Public-private partnership arrangement, PPP. So the idea here is that the government of Ghana or the covered entity in question, when we say covered entity, is simply an entity whose activity is financed either in part or in whole by the government. So the contracting entity will be on one side, then the private sector investor will be on the other side. So what happens? The private sector investor is going to provide, so let's say this is the project. The private sector investor may provide a couple of things. Sometimes we need their funding, okay, money. Sometimes it is just expertise we need because we don't have the expertise that we need. Sometimes it could be a technology that we want to use. It can be done under public-private partnership arrangement. So project or maybe policy objective. So private sector is coming in, government wants to do something, but doesn't have the funds, doesn't have expertise, may not have the technology, but the private sector can have it. Now, it's there, but government doesn't have the money outright to fund it or pay for it outright. So we bring the private sector entity to fund it. Now, sometimes, yes, the government may provide, in some cases, technical support, okay, and other, maybe partly funding the project as well, depending on the way the deal is, and we'll get into this in a moment. But that is the idea. There is a project, there's a policy objective that has to be executed, and guess what? We bring in the private investor, bring in funding or expertise or technology. But the big question is, how does the private investor get paid? Because remember, the objective of any private entity is to maximize the wealth of the shareholders, and that is through profitability. So we want to maximize our profit because at the end of the day, we will maximize the profitability of the entity. So how does the private sector get paid from the project? There are various ways that governments can give back the private investor the money they have put in plus their returns. Sometimes it can be user fees. So when you use it, then you pay. So like a road, then it will be tolled. So there will be toll on it. There are toll booths there. So anytime you use the road, you pay the toll. That is making the contribution towards the payment of the project. So user fees. Another way governments can pay back the money is through budget allocation. All right, that is the annual budget allocation. Annual budget allocation. That is another way through which government can pay back. Or the third way is the two. Because the reason why the two is important is because of this. So let me give you an example. Let's say that government wants to increase sanitization. And one way to do that is to prevent people from defecating by heart, by the sea, in the bush, and various places. So to do that, then there has to be affordable public toilets. So the government can say, okay, we want to build some public toilets, okay, in the various communities that these things are not there. So government doesn't have the money, but government can bring in a private person to come and build these toilets. Now, the private investor will put their money inside, and the private investor will ask government, how am I going to get my money? Then the government will say, oh, charge the people. So the private investor, after constructing the toilet, WC, everything, crepes, everything done nicely, then what will happen is that the private investor will say, hey, if you come and poo-poo, the fee that you're going to pay for poo-pooing is 3 Ghana cedis. Bro, this is a community where we can go to the bush, do natural thing, and then we will be good. There is some air that will be blowing around you. My God, that feeling is something else. We should pay 3 cedi for it. Do you know that we could use 3 cedi to buy some Kobe or some money to do Ampesi? So if the private investor is going to charge the end users 3 Ghana cedis to just defecate, to poo-poo, they're not going to pay. They will continue to poo-poo around the sea or poo-poo in the bush somewhere because that's better off. So governments can then step in and say, okay, per the way your plan is, you can, and how you have to get your money back, if you charge 3 cedi, it's going to be expensive. So governments can step in and say, okay, I'm going to divide this into 2. Okay, I want to step in and pay half for the citizens. So charge the citizens 1 cedi 50 pesos, then I will pay the remaining 1 cedi 50 pesos. That is the idea about the third option, both of the above. So the service fee would then be subsidized so that the government comes in to pay the excess amount required to be given to the private investor. These are the things you must understand when we talk about public-private partnership arrangement. And that is the idea about public-private partnership arrangement. Very easy. Very easy. But let's open the discussion up a little bit. To open up the discussion, first, we want to look at the key principles of public-private partnership arrangement. So, key principles of public-private partnership arrangement. Because you see, to be able to execute what has been agreed on, there are some principles that must govern each public-private partnership arrangement. There are rules and regulations that must guide the way these things are supposed to be done. So what are the principles of public-private partnership arrangement? Let's look at a number of them. The first principle is value for money. Now, this principle states that the public-private partnership project should not cost the country beyond the expected amount payable under similar circumstances in other countries. So that's the first thing, value for money. The fact that we are bringing in a private investor and the private investor's goal is to maximize profit does not mean we have to pay more than a similar project executed under different conditions or in different countries in our contract or in our arrangement. That's the first principle, value for money. But you see, there are three elements of value for money that we need to understand when it comes to dealing with value for money. And that is economy, obtaining resources at the least cost. Then we go to efficiency, looking at the relationship between the input and the output, meaning getting the best possible outcome from the utilization of resources. And then number three, effectiveness, that the intended project will meet its objective. That is what we mean by value for money. So let's say that again, if we come back here, toilet facility. Government has undertaken that under a public-private partnership arrangement. Okay, so how much will each toilet facility cost the government? Or will it cost? Then the contract has arranged that each toilet facility will cost $100,000. Economy means per the facility there, is it worth $100,000? Or we are paying exorbitant amount of money? That is the concept of economy. The amount that we are paying for the project, is that what we are supposed to pay? And so one way to resolve the issue about economy is to ensure that when a covered entity or government is intending to undertake a PPP project, they have to do that in a competitive environment. In other words, there has to be various private investors, various private contractors who are coming in so that through a bidding process, government can select, or the entity can select the one that will help us to not break the bank but still get the thing. Then efficiency is a relationship between the input and the output. So if 100,000, what are we getting out of the 100,000? Then the last one is effectiveness. Is the project that we have put across achieving its intended objective? So if we say we want to prevent people from poo-pooing in the bush and poo-pooing by the sea, so we are building this toilet. But then the toilet has been built, but people are not using the public toilet and they are still poo-pooing by the sea and poo-pooing in the bush because, the natural air and the experience that they will have is so succulentious. That means the project is not achieving its intended objective. So on the overall, maybe we did not achieve value for money in that project. That is the first principle of all PPP projects, value for money. The second principle is risk allocation. Every PPP project must table out and give detail on the various risks that are associated with the project, and most importantly, how those risks will be borne. In other words, who will be responsible for what risk? The government. What risk is the government responsible for to handle? Public sector investors. What risk are they responsible to handle under the contract? That is the idea about risk allocation. But it is important you also understand that when it comes to risk in public-private partnership arrangement, there are types of risks. So let's go through some of the types of risks quickly when it comes to public-private partnership arrangement. The first one is called construction risk. What is this? This represents all the issues that may arise at the construction phase of the project. So, cost overruns. Maybe we wanted to build a public toilet and it will cost $100,000. But by the time we started, because of inflation or economic issues, There are certain things that had to be imported, and all of that. Now we are going to spend around $150,000. That extra $50,000, no, it's called construction risk. In a PPP arrangement, the question is, who bears that risk? Who will bear that risk? Is it a private investor or the government? Or it will be borne by the two parties who bears the risk? But that is the idea about construction risk. Then building material defects. So the materials that have been bought to use to undertake the project, by the time we started construction, we have identified some defects in them. Who bears that risk? Whose responsibility is that? Then, technical deficiencies. All these are construction risks. Then we come to the second type of risks, and that is availability risk. This refers to the risk that the infrastructure may not be sufficient for the end users. So this risk comes at the end of the project, that we've done the thing, it is ready for use, but it is being overwhelmed. The fact that it is not enough to serve all the people. That is the concept of availability risk. Now, the reason why this may come up may be because of poor planning and poor execution of the project. Because if we have, say, a community that is having maybe 50,000 people in the community, and we are doing public toilet, and 50,000 people, you build or construct only 10 public toilets in the community, and that is all there is, I think that there will be an availability risk. Because, I mean, people get up and they got to poo-poo, and there are only 10 public toilets in the city, or in that town, or in that location. There will be problem. So, to prevent that, imagine... Sorry, I'm using poo-poo, okay, but I hope you understand, so bear with me. So imagine you get up early in the morning, and then you want to poo-poo. Then you go to the public toilet. There is a long queue there. I mean, how many people can hold it and say, I'm going to wait until Kofi Ama Ajua Akosua Kukua Ohema finishes before I go? By the time you realize, people will just revert back to auto reset. Let's go by the bush. Go poo-poo in the bush. Some natural air will pass by you. My God, that feeling is overwhelming feeling. So that is the concept of availability risk. That although the project is done, it can be used, it may not be sufficient for the end users. And that has a lot of disadvantages. 3 is demand risk. So this is the flip side of the availability risk. This refers to the risk that arises as a result of the viability in the amount of service required or consumed by the users of the infrastructure. So the demand risk is you will undertake something and nobody will be interested in it. Or the people who are interested in it are fewer than the capacity. That is the demand risk. So the demand risk is the reverse of the availability risk. Again, why will this happen? Because of poor planning. So although the project is done, many people are not using it. Now, another reason why this could happen is because of the price. Like what I mentioned earlier, end user fee. We want to poo-poo, you are charging 3 Ghana cedi to poo-poo. I'm not going to pay 3 Ghana cedi to go poo-poo. So let's go to the bush rather. That's better. And that is what people will do. So although the facility is available, they will not use it because it is too expensive for them. That is the concept of demand risk. 4, residual risk. This refers to the possible difference between the expected residual value of the infrastructure and the actual value at the end of the agreed period. I will come back to this concept later, but get it here. The concept under PPP arrangement is that there are types of PPP where the private investor build the thing and then maintain it and then get his money at the end, transfer the residual assets to the contracting entity, the government, or the covered entity. And so at the beginning of the contract, there will be an expectation that, oh, maybe this is a 20-year deal. At the end of the 20 years, the value of the property you give us is $10 million. But sometimes, by the end of the 20 years, the date that the asset is being transferred or the infrastructure is being transferred to our entity, the value of the property is just $5 million. So the difference between the expected amount, 10, and the actual amount at the date of the transfer, 5, is called the residual risk. The question again is, who bears that risk? But that is something we must understand when it comes to public-private partnership arrangement. 5, financing risk. I believe you don't need miracle on this one because, the eating is in the pudding or whatever. Those of you who went to Montessori, you know what that means because it's obvious, right? It refers to the risk that full funding required for the project will not be obtained at the expected interest rate or may not be available or accessible. That's financing risk. Because remember, the private investor is not that they have the money sitting there. Sometimes the private investor will go borrow the money. Because, it is cheaper to borrow money to use it for your business, for tax purposes, rather than using your own money. So the risk that when we want to now begin the project, we thought that we will borrow the money at 10% interest rate, only for the project to commence, and now we are supposed to pay 15%. We thought that we will get the $10 million for the project, only for us to go to the bank when the project was about to start, and the bank says, hey, we are facing situations by ourselves, so we can only get you $4 million. What happens? How do we get the extra funding to pay for the project? That is financing risk. Then number 6 is maintenance and operational risk. Again, this is obvious. You don't need a miracle on this. Maintenance and operational risk. These relates to all the other issues arising in the operations of the infrastructure, the regular maintenance, making sure that the asset is operating at its optimum capacity. Who bears that risk? Who pays for that? That is the idea about maintenance risk. It's important you note this, that the risks must be allocated to the party, that is either the contracting entity or the private investor, with the requisite expertise to manage the risk effectively in order to maximize value for money. Because if it is about financing, and it is a private investor bringing in the money, then issues about financing risk, the private investor should have the expertise to handle it. If it is about the day-to-day running of the infrastructure after it is done, then based on the contract, who is supposed to bear it? If it is the government that is going to run it, then the government bears that. So we have to know these risks because it must be allocated to the party with the expertise to be able to deal with the risk so that on the overall, we can maximize value for money. So these are the things we must understand when we talk about types of risks. And this is a specific question the examiner can throw at us in the exam hall that we need to be mindful of. So principle number 1, PPP projects must achieve value for money. Principle number 2, risk allocation. Principle number 3 is ability to pay. If end users are going to be charged, then determining the price or the amount to charge the end users, the purchasing power of the end users must be considered. Remember the example I gave earlier, that we want to deal with sanitation, increase personal hygiene, and so by that, we want to discourage people from poo-pooing at the sea or poo-pooing in the bush. Okay? But then we have the public toilet, and you are charging end users 3 Ghana cedis. They're not going to pay 3 Ghana cedis to go poo-poo. So when you are charging them, you must consider the ability of the end users to pay. If it is too expensive, they won't pay. So then there will be demand risk. That is the idea there. So that's what you must understand when we talk about the principles of ability to pay. And then the number 4 is local content. One of the key issues in each PPP project is that there has to be some local content involvement. What does that mean? It means that if we are dealing with the partner in question, and the private entity in question is especially a foreign entity, and they are going to undertake the project, they must ensure that if there are things available in the country, there are companies producing some of the inputs they will need, there are expertise in Ghana that they will require, they must use Ghanaians. They must buy from Ghanaian producers and suppliers. They must use the Ghanaian expertise. That is the concept of local content. The idea is that will become like a transfer of knowledge and technology and expertise, so that there will be a time coming in the future we wouldn't have to bring in foreign entities to come and do the same thing, because we have built the capacity of our local industries, expertise, firms to be able to do the same thing going into the future. That is the concept of local content. So as much as possible, if it is available, then the contractors, the private entities, must use the local content. Very important. Very important. Then the principle number 5 is transfer of skills and knowledge. And that is what I was tying into this local content principle. That at the end of the day, if we are going to be dealing with a foreign person, a foreign entity, then they must have as part of their plan in undertaking the project to train, to transfer skills, knowledge, expertise, technology to locals. These are some of the principles we must understand when we talk about public procurement. So, the types of risks is a question the examiner can access. The principles of public procurement is a question the examiner can access. But the question we then have to ask ourselves is, what are the types of PPP available? What are the types? So, yeah, we want to increase personal hygiene, prevent people from poo-pooing at the sea, in the bush, and all that, and build some toilets. So what are the various types of public-private partnership arrangement policies that we can go in for? Please stay with me carefully here. I'm going to take them in pairs. Then we will explain what they are. Then you understand the concept. So types of public-private partnership arrangement. So number 1, BTO and BOT. So build, transfer, operate, and then build, operate, and transfer. Now, listen to the naming very well. What is the difference between the two? One thing you must understand is that in these two types of public-private partnership arrangement, we are constructing a new thing. We are building a new thing. And so it is a new project or asset. The private investor invests in it. But this is what happens. The difference between the two is that transfer for build, transfer, and operate takes place immediately the project is completed. Stay with me carefully. So the private investor constructs the project. So it could be a road or it could be a hospital. And the build, transfer, and operate, when they finish building, they transfer ownership of the asset to the government of Ghana. Then the government of Ghana in return give them the right to operate it for a given number of years to recoup their investment. That is build, transfer, and operate. So under build, transfer, and operate, the asset is ready. The transfer in ownership of the asset occurs immediately the project is ready. Then the private investor is given the right to operate the asset for an agreed period of time to recoup their investment. But here is the catch. The both build, operate, and transfer, still the private investor injects money, builds the asset, is allowed to operate the asset, and then transfer it at the end of the life of the project or at the end of the agreed time. So under build, operate, and transfer, the transfer occurs at the end of the agreed term, after the private investor has recouped their investment. So that is the difference between build, transfer, operate, and then build, operate, and transfer. That's the difference between the two in that particular case. Now, so what is happening here generally? In the two cases, it's a new project, it's a new asset. In the two cases, the private investor funds it. In the two cases, the private investor is given the right to operate the asset to recoup their investment. The difference between the two is that in build, transfer, and operate, transfer occurs right after the asset is ready. But in both build, operate, and transfer, the transfer occurs at the end of the agreed period. And so the issue is that residual risk is sort of reduced when we do build, transfer, and operate, and residual risk is sort of increased when we do build, operate, and transfer. Because under build, operate, and transfer, we will get the transfer at the end of the agreed term. And it's likely that when that agreed term is becoming due, or nearing, the private investor may not maintain the asset well. But in the build, transfer, and operate, we've transferred. So we are just giving them the right to operate it. And so we have a lot of control as to how they can do their work. So that is the first two types that we need to understand. Then we come to the second two types, Mo and SE. That is not Mo Salah, but maintain and operate, and then SE is service concessions. The reason I'm taking them two is because of the relationship that exists between them. Now, here we have an existing asset. Okay, so there is an existing asset. But the problem here is that the asset or the entity is not being managed well, or it is not operating at its optimum. So we are underperforming. Efficiency is below what is required or what is expected. So the private investor is engaged to come and provide the public services so they can increase efficiency of the entity. So that is what is happening in maintain and operate and service concession. There is an existing asset, there is an existing business, but it is operating at below its capacity or not efficient. We bring in a private investor, a private entity, to come and provide the public goods or provide the public services and increase efficiency. Now, the difference between maintain and operate and service concession is that in maintain and operate, this is just like an agency relationship. So the private entity is just coming in to operate the assets, increase efficiency at a fee. So the government will pay the private entity to come and just take it. It's like I have a shop. Then I employ you to be the shopkeeper there and sell on my behalf. That is the maintain and operate. So it's an agency relationship. The private investor is brought in to come and operate the asset for an agreed fee. Then the private entity is not required to make any investment because they are just agents. So in maintain and operate, the private investor doesn't make any investment. So I have a shop. I brought someone in to be the shopkeeper. I'm going to pay the person monthly salary. If something is going on in the shop, the person is not supposed to use their money to fix it. They are not supposed to put any money in it. So it is the contracting entity or the government that will invest, provide all the necessary resources that are needed, and bears all the risk associated with the maintaining of the asset. And usually, more that is maintain and operate is a short time. It's below 5 years. That is what we must understand in respect of maintain and operate. Now, service concession, on the other hand, again, there is already an existing asset. Just that the asset is not operating to its optimum, or it is operating under or below capacity, or there is a lot of inefficiency. So in service concession also, the private entity comes in. But this is what happens. The private entity doesn't just maintain the asset or operate the asset, but the private entity will also be required to bring or inject additional capital. So in service concession, the private entity is required to bring in additional capital. That is the deal here. The private entity brings in additional capital. What it means then is that under service concession, the risk associated with the asset now, with the project now, will be allocated between the private investor, because they've brought in some money, and then the contracting entity. And so here, the private investor must operate the asset for an agreed period of time so they can recoup their investment. And usually, service concession will be a long period of time. This is what we mean by maintain and operate, and then service concession. So those days under the previous administration, the Akufo-Addo administration, when they did that PDS thing so that it was a service concession deal, they were like, yeah, ECG is not operating to its full capacity. So they brought in a consortium, PDS, to come and take over ECG. And the idea was that PDS was supposed to inject some money. Now, the reason why that deal was cancelled was because later on, per investigation, it was allegedly identified that a lot of the documentation and the bonds that they submitted and the various things were all fraudulent, cannot be verified. All the banks were not ready to provide the necessary funding, and so that deal was cancelled. But that is service concession there for you. So, build, transfer, operate. Build, operate, transfer. Mo, not Mo Salah, but if you remember Mo Salah, then maintain and operate. SE, not Supreme Court, but service concession. Then we go to the third category of the discussion. The third category of the discussion. And that is boo. So if you remember my boo, you can know that. And then rot. Boo and rot. Now, these two have nothing in common. They have nothing in common. But they are the remaining two left, so I just bundled them together so we can look at them in that particular case. So, boo. Build, operate, and transfer. Sorry, build, own, and operate. Sorry. Build, own, and operate. Boo. This is where we are talking about the fact that the private investor builds the thing, operates it, but never transfers it. And this is where Agenda 111 comes in. That is one district, one factory. So the one district, one factory agenda was under BOO. So private investor builds the project. Government provides them assistance in various forms. It could be financial, it could be technical support, it could be supply chain or research report. And at the end of the day, the private investor operates the project and there is no transfer. So the one district, one factory agenda, it was under BOO. Build, own, and operate. And so under the one district, one factory, the way the deal was done was that, yeah, you have a business plan. Bring the business plans to the Ministry of Trade and Industry or Ministry of Special Initiative or Development at the presidency. They look at your business plan. If everything is good, government is going to provide you with various things. It could be technical support. It could be financial services. Financial assistance or their supply. So if the investor had worked independently to the bank to get some money, the bank will require collateral facility and may lend the money to them at a higher interest rate. But under the one district, one factory, there is virtually no collateral facility and the interest rate will be lower because government is stepping in and then paying the remaining or the difference in the actual interest rates that you should have paid. That is the concept of BOO. Build, own, operate. There is no transfer. It is a private entity. Then we come to ROTS, the final one, ROTS. Please note, the concept we are discussing here, it could be types of public-private partnership arrangement, sometimes can also be referred to as models of public-private partnership arrangement. So just understand the terminologies very well here. So we go to ROT. ROT is rehabilitate, operate, and transfer. Rehabilitate, operate, and transfer. What is this? Here, there is an existing asset. But the asset is not operational at all. So it requires to be revamped. So it is not operational. I need you to be careful with ROTS and then SE, service concession. Service concession, there is an existing asset, there is an existing business, it is operational, only that it is operating below its capacity and there is no efficiency. That is service concession. But in ROT, rehabilitate, operate, and transfer, the asset is there, but it's not operational. But we want to revamp it. And so in that case, governments can invite a private investor. So the private investor is required to invest capital to make the asset operational. Then they are allowed to operate it for a given number of years to recoup their investment. At the end of the day, they transfer the assets back because the assets belong to the government anyways at the beginning. So under ROT, we are not building anything new. An existing asset that is no longer operational, but government wants to revamp it, they can go with ROT. And normally this is longer. It can be above 25 years. Now, the funny thing is that something like the Commander Sugar Factory, if you're somebody who follows politics in Ghana here, it's one of the things that has really gone through a lot of things. Under Mahama 1.0, there were a lot of skirmishes under that. Oh, we've opened Commander Sugar Factory. Oh, it is working. Then, gooding. Over the last 8 years under the Akufo-Addo administration, the previous Akufo-Addo administration, the same idea. And there they will open. Ochina they will open. And there they will open. Ochina they will open. It's not operational. But it has gone through a lot of iterations under ROT. There are a lot of private investors that have been brought in to look at it, to revamp it, but it hasn't been really something to write home about. But these are the things you must understand when we talk about rehabilitate, operate, and transfer. ROT. Right. So if you pay attention now, we've spoken about 6 models or types of public-private partnership arrangement. BTO, BOT, MO, not Mo Salah, SE, not Supreme Court, BOO, Build, Own, and Operate, and ROT. But there is one more, and it is called DBOT. Okay? DBOT. And that one is design, build, operate, and transfer. Now, this is a specialized model designed for specialized contracts. What do I mean by that? Normally, sometimes there are specialized projects that has not been undertaken before. So, for instance, the idea about that hole that they have dug in the middle of Accra, the National Cathedral, it was a special kind of project that we haven't seen something like that before. So if truly government wanted to have done that and do it in the name of the government, because remember, the National Cathedral fiasco started as a private dream, and then it turned into a national cake, and then later on, we don't know what happened to it again at the end of the day. But for the National Cathedral, it's not something Ghana has done before, probably. And so it's a specialized project. So based on the way they are designing it, they said they will have museum, it will have restaurants, people will be coming in. So it's a monetized project. So they could have done the National Cathedral idea under this model called the boat. So what will happen then is that the private investor will design the project. Because under boat and BTO, the design is done by the government. But in the boat, the private investor will do the design. Then they will invest the money to build it. When they finish building it, they are given time to operate it for a number of years. And then after that, they can transfer the residual asset to the government. That is the idea about the boat. So the National Cathedral thing, they could have done it if there is an entity available, a private investor available, who will be interested in such projects, and it will be profitable to them at the end of the day. Okay, because it has more of religious sentiments than business sentiment. All right? Because, people were propagating a lot of things about that thing. But these are the things. So these are the 7 types, or if you want, models of public-private partnership arrangement. So, for instance, we could have some scenarios coming in here. So let me give you a question here that we can look at. Required. Explain how governments can employ public-private partnership in realizing the attainment of its programs and projects. II. Suggest an appropriate PPP project for each of the 3 projects above within the fiscal constraint of government, emphasizing how the proposed arrangement will help to achieve the results. So let's look at what we have there. The government is currently experiencing serious fiscal challenges as a result of COVID-19 recovery programs. Despite the fiscal challenges, the government wishes to complete the following projects and programs during the year. Massive road construction that will cost in excess of 10 billion. Massive road construction that will cost in excess of 10 billion. So if it is road construction, the common model used for road construction is BTO. So the private investor invests the money to build the roads, transfer it to the government, then government gives them the right to toll it, to get their money back over a given period of time. So the favorable model used for road constructions, significant amount is build, transfer, and operate. Then we come to point number 2, and that is drastic improvement in electricity power generation and distribution throughout the country, which requires an injection of not less than 6 billion Ghana cedi into the operation of the Electricity Company of Ghana and Volta River Authority. The government does not want to lose its ownership of the energy sector. So if you remember, this one, it means we are going with SE, service concessions. So we bring in the private investor. The investor injects the 6 billion into the Electricity Company of Ghana and Volta River Authority. It is still our company. They are allowed to run it for a given number of years. It could be 20 years, 30 years. Then we get our thing back at the end of the day, and that is all. Number 3. Efficient management of University of Ghana Medical Center to increase revenue generation through quality service delivery to the entire sub-region. So again, there is already an asset, the Ghana Medical Center, the University of Ghana Medical Center. The goal here is that we want efficient management so that we can increase revenue generation through the provision of quality service in the entire sub-region. So we don't need money. We only need expertise coming in. So the type of PPP arrangement we will use there is MO, maintain and operate. So the private entity is going to come in to manage the University of Ghana Medical Center, and we pay them a fee. And they are not supposed to inject any money because we don't need money. We need management and increasing efficiency. These are the things you must understand when we talk about the types or models of public-private partnership arrangement. I see some of you guys joining. If you're getting some value, give us a thumbs up. You can also share the video so we can reach as many students as possible watching the playback of the video. And then if there are any questions you have also, you can put them in the comment section for me, and I'll be providing you with the answers in respect of these things. So these are the things we must understand when we talk about public-private partnership arrangement. The last thing probably that we can say will be the limitations or disadvantages of public-private partnership arrangement. You can see from the discussions we've had that then government can leverage public-private partnership arrangement to deal with our infrastructure deficiencies. So government shouldn't be the one funding the thing. But you see, there are various disadvantages about this. The first one that we can talk about, limitation, the first one we can talk about will be the issue about profitability. Not all projects may be profitable at a glance. So private investors may not be interested in it. Like the example I was given in respect of the National Cathedral fiasco. Right? The example of the National Cathedral that I was given. If that thing was being done under private, under public-private partnership arrangement, and we wanted a private investor to come and build a national cathedral and all the things that we wanted, I don't think we will get a private investor to come and do that, because maybe the value proposition, how long is it going to take? Because the idea of the National Cathedral, they were looking at it that, Ghana will become a destination so that people will not travel to Israel again. And I'm like, bro, what is the Christian connection about Christianity in Ghana? Very quite delusional thoughts process though, but how do we do it? So it's something that government may want to do, but private investors may not see the value for their return on investment as quickly as possible based on the nature of the project. That's one of the limitations. The second thing is the issue about cost. Sometimes public-private partnership arrangements become more expensive than if they were financed by the government through taxation or through loan. Why? Because the private investor requires return on their investment. So if private investor is coming in and they are bringing in 6 billion Ghana cedi, then over 20 years, we will end up likely paying them about 20 billion Ghana cedi, depending on how the deal is structured. So if you look at it on the overall, we need 6 billion for something. But if we allow a private investor to do it, in 20 years' time, that is now going to cost us $20 billion. So that is one of the limitations as well of public-private partnership, because it may become expensive because of the profit motive that the private entity has in executing projects. That's the idea there, and that's what you must understand. Another limitation is the frequent change in the politics or in the government. Because, for instance, now that this new administration, this new Mahama 2.0 administration has come, there are a lot of things that have been cancelled under the previous administration. Because under the previous administration, they were doing one district, one factory. I don't know how true that thing was, though, but we move. Because I don't know how many factories they built or funded and what has been the impact of that. I don't know. But government is not pursuing that agenda. Government is pursuing something else. There had been Agenda 111. Government is constructing hospitals. I don't know if this new administration, they're going to pursue and finish some of them. Although they have promised, I don't think they're going to do it. It depends. And it happens like that because when Akufo-Addo also came, many of the projects that Mahama had done, they didn't continue and operationalize it. Again, if you follow politics in Ghana, there were times when many schools that were built under the Mahama administration, they were left to rot in the bush. And chiefs came out and were requesting the presidents to come and what? Operationalize the school so that it will help the community. And at times, if you follow politics again, some of the things that the president allegedly said to some of these chiefs. So that is also something that discourages private people from partnering with the government. It means that you can undertake a PPP project, you are doing your job, and new governments can come and say, hey, when we did the investigation, we are overpaying this deal. So we will terminate this contract. And whatever penalty is supposed to be paid, we will pay it to you because we have to give the contract to someone else. So that also discourages private investors from showing interest and investing in PPP projects. So these are some of the limitations you must understand. And these are the things on the overall that you have to understand when we talk about public-private partnership arrangement. That's it. We are done. So that's the first thing under the public sector issues, public-private partnership arrangement. So we're going to take a short breather, and then we will come back and we'll go to the second layer, PIFA. Then we will go to the third layer, public procurement. Okay, so let's go. Now, I want us to balance things out a little bit. So let me shift my attention to calculation related area a little bit, okay? So that we'll have a balance, okay? So let's go to some calculation issues under working capital management so that, it doesn't sound boring. We got to be engaged a little bit. So let me bring in one of the calculation areas. Then after that, we'll come back to one of the theories. Then let's see how far we can balance this. So let's come to working capital management, and we are looking at this particular question. You can download a question under this video on the portal. So question number 3, plot score under working capital management. Remember, as per the syllabus breakdown, working capital management is a 15 marks area that we need to be mindful of. Done deal waiting for us. So when it comes to working capital, working capital is current asset, okay, minus current liabilities. And so you know from KG2 that the current assets are made up of two things, a number of things: inventory, trade receivables, cash, and trade payable, prepaid expenses. Okay? But for the purpose of our discussion, we need to know how to deal with inventory management, know how to deal with trade receivable management, know how to deal with cash management. Then you come under current liability. Under current liabilities also, we're going to have trade payables, okay? Certainly bank overdraft and other things. But we're going to be excited more on trade payables. So component-wise, under this topic, we're going to be focusing on inventory management, trade receivable management, cash management, and then trade payables management. Now, the key question we ask ourselves is, what are the objectives of working capital management? Broadly, there are two objectives of working capital management. It's to achieve liquidity and also increase the profitability of the entity. That is what you must understand when we talk about the objectives. Liquidity, meaning we have enough cash available, profitability, increasing our profit, and then maximizing the wealth of our shareholders. That's a two broad objective. I'll come back to these, so let's just go straight up into the question, and I need you to stay with me carefully here as we build this calculation into our story. Required. Calculate the following values for P, for product P. The total cost of the current ordering policy, total cost of the current ordering policy. It means you are calculating the inventory cost. And if you're a good student, inventory cost or total cost of the inventory will be your ordering cost plus your holding cost plus the purchases cost. Those are the three things adding up to inventory cost. The ordering cost is the cost you are incurring per order. Holding cost is the cost we are incurring for storing or keeping the inventories. Purchasing cost is the actual money you are paying for the inventories. So let's read the story for product P. Stay with me carefully. It says, Plot Co sells both product P and product Q, with sales of both products occurring evenly throughout the year. Product P The annual demand for product P is 3,000 units. Stay with me carefully. Annual demand is 3,000 units. And an order for new inventory is placed each month. Stay with me. So the ordering time is each month. That means for the year, there are 12 orders. It says each order costs $162 to place. Okay, so quickly, let's begin the journey. Plot Co. So the ordering cost will be 12 orders within the year, because they said each month, multiplied by $267. That is a cost per order. And that is 3204 per year. Okay. Let's continue. The cost of holding P in inventory is 10 cents per unit per year. So that's our holding cost. We'll come back to that. Buffer inventory equal to 40% of 1 month's sales is maintained. So the amount of inventory they maintain is 40% of 1 month's sales. So the question we ask ourselves is, what is the sales for every month? Then we get 40% of that, then we can get our holding cost. So monthly sales, which will be the same as the monthly order, will be the annual demand, 300,000 units, divided by the month in the year, 12. So each month, how many units do we order? That's 25,000 units. So 25,000 units. That is a monthly sales or order. Then we are told that the buffer inventory, what they must keep at all times, is 25% of 1 month's sales. So 25% of each month's sales, which is 25,000 units. So my answer times 0.25, and that is 6250 units. So that is our buffer. Now you need your holding cost. Holding cost is going to be your average inventory plus the buffer times the cost for holding. So let's get our average inventory for the year, excluding the buffer. And that is going to be your annual inventory. So let's see. Cost of holding is 10. Okay. So the average inventory we keep is going to be the monthly divided by 2. And that's going to be 12,500 units. Yeah. That's the average inventory that we're going to have. So now, the average inventory including the buffer, will be the 12,500 units plus the buffer 6250. 6250 units. Okay. Hey, give me a sec for my arithmetics well here. I need my arithmetic. 0.4. Wait, the buffer is 40%. Okay. So I'm missing something. So the buffer is 40%, not 25%. So 40% on the 25,000, and that is 10,000 units, rather. So the average inventory, 12.5. So that the average inventory, including the buffer now, is going to be 10,000 units plus the 12,500 units. So that our average inventory for the year is now going to be 22,500 units. So this is the average inventory, including the buffer that we will be keeping. So now based on that, we can get our holding cost. So our holding cost is going to be 22,500 units times, they said cost per holding or cost of holding is 10 cents. That's $0.1. So we punch that out, 22,500 by 0.1, and that is 2250 per year. Now, per year, not per hair, Nhyira. Now, for product P, which is what we are working for, we don't have the cost of purchases. They didn't give us the purchases cost. So although our formula for inventory cost is ordering cost, holding cost, and the purchase cost, there is no purchase cost there. So in the context of this question, it means we will do holding and ordering, because that's what we have. So the total cost will be the holding, the ordering 3250 or 3204 plus the holding 2250. So plus 3204, and that is $5454. Okay, 5454. That is the idea about the total cost. So that is the I part of the question for the current ordering policy, that they order inventories once a month. Okay. We go to II. II says the total cost of ordering policy using economic order quantity. Okay. So the economic order quantity is the units that must be ordered in order to optimize the cost of the entity, the ordering cost of the entity. And so the formula for the economic order, so it means we have to calculate the economic order quantity, divide it by the normal annual demand so that we can get the demand for the year, and then we will go with the same approach. Then you will see what we are supposed to do. So permit me to bring the economic order quantity formula. So this is the economic order quantity formula. So this is the holding cost. This is the annual demand. The C is the ordering cost. the square root, the 2 is a constant. All right? So we need to calculate the economic order quantity for the second scenario. So the second scenario is the total cost at the EOQ. Economic order quantity. So let's get the economic order quantity. It will be square root of 2 times the ordering cost, which was given to us to be 267 per order, multiplied by the annual demand, which is given in the question, annual demand 300,000. We divide that by the holding cost, which is 10 cents, 0.10. So we punch that out, and that will give us the economic order quantity. So if you have a good calculator, you have the square root fraction, 2 times 267 times 300,000 divided by 0.1. And that gives us an amount of maybe 40,000 units approximately. Okay, 40,000 units approximately. It is 40,023 units. Okay, 40,023. But we can run it to make it 40,000 units to work with. So if the economic order quantity is 40,000, then how many orders must we make every year? So number of orders per year. And that will be your annual demand, the D, over the EOQ, the economic order quantity. And our annual demand is 300. Economic order quantity, the 40,000. So what will be the number of orders we will make within a year? 300,000 divided by 40,000, and that is 7.5 orders. So now that we know we will make 7.5 orders, then the next thing we do is to calculate the ordering cost. So under the EOQ, our ordering cost would then be equal to 7.5 times the cost we incur per order. And the cost per order is 267. So 7.5 times 267, that is 2,000.5. So 2002.5. So we can do 2003 Ghana cedis. So that's our ordering cost. But we need to bring in the issue in respect of those other things we did. So we need our buffer inventory, we need our average inventories, the same ideas. So let's go and work it out. So first, let's get our buffer inventory. So the buffer inventory in this era, okay, EOQ, so we wouldn't need any benchmark. Let me go straight. Give me a sec. Because the buffer inventory, we already have it. So let's just go with the average inventory now. Excluding the buffer. Will be the EOQ divided by 2. So EOQ divided by 2. So 40,000 divided by 2, and that's going to be 20,000 units. Okay, 20,000 units. Now, our buffer inventory is still 10,000, so we don't need any problem on that. So now, average inventory, including the buffer, will be 20,000 plus the 10,000 buffer, and that becomes 30,000 units. So since we now have this, we can now calculate the holding cost. So the holding cost is going to be 30,000 units multiplied by the cost per holding, 0.1. So 30,000, 0.1, that's 3,000. So my total cost will be 3,000 plus the ordering costs, 2003. And that's going to be 5,003 per year. So in the economic order quantity, we will spend 5,000 per year for total cost of the inventory. If we go with our normal ordering, then our total cost will be 5,450. So in that case, it is better to do the economic order quantity. All right, so that every time we are ordering, you order 40,000 units. That way, you are going to order only 7.5 times in a year, as compared to ordering every month, okay? So that your ordering cost in that case becomes 12 times in a year, so that it goes up. So it is cheaper in the context of this scenario to order 40,000 units each order based on the economic order quantity. But that is the II part of the question. Let's continue. III. It says, the net cost or savings of introducing the ordering policy, an ordering policy using the economic order quantity. I've already answered that question. So the calculation. So III. It says net cost. It will be a savings. Because if they change to the economic order, they will now spend just this. So let's see. Net savings from introducing the EOQ as a policy. So it will be our current total cost, which is the 5,454 minus 5,003. 5,454 minus 5,003. And that is 451. So when we shift from ordering every month to ordering only 7.5 times within the year and ordering at the economic order quantity 40,000 every time, it will save us 451 Ghana cedi per year. That is the idea about the A part of the question. That's the idea. And this is about management of inventories. Then we come to the B part of the question. The B part of the question says, calculate the net value in dollars to Plotco for accepting the early settlement discount. So here, we are going to trade payables management. Because remember, in the short term, one of the sources of finance is trade payable. So we have to look at what is happening. If we are giving an early settlement discount, it means you will pay your suppliers on time then in that case, you will get some discount. But if you are going to pay your suppliers early, then the money you will need, you would have to go borrow it from the bank. And then you have to incur finance costs on that money. So you have to understand what is going to happen here. We're going to be looking at the difference between what will happen if we take the early settlement discount, the benefit we will get, and then the finance cost that we would have to incur to borrow money to finance our activity. Because remember, trade payable is a source of finance to the company. So two options. Should you pay your suppliers early and get discount, so that you rather go and borrow money and pay interest to run your business? So the discount you are getting and the interest, which one? So that is the premise for this particular question. So let's look at it. B, product Q. Again, if you pay attention closely, one of the things you're going to be doing sometimes in the exam hall, and I say this always across all subjects, is knowing which portion or which part of the question relates to which part of the requirement of the question. That is very important. That's very important. So let's go. The annual demand for product Q is 456 units per year. And Plotco buys this product at $1 per unit on a 60-day credit. So the normal payable period is 60 days. The supplier has offered an early settlement discount of 1% for the settlement of invoice within 30 days. So if you pay the invoice within 30 days, I give you 1% early settlement discount. Let's continue. Other information. Plotco finances working capital with a short-term financing costing 5% per annum. So if you are going to pay your supplier, then you have to go borrow short-term finance at 5% per annum. Assume that there are 350 days each year. So what do we do? Let's look at it. What is the current? Assuming so B. So if we are going with a normal issue, what is the current? We buy this on credit, right? So trade payable, annual trade payable. Or let me not say annual trade payable. Let me just say trade payable. First, it is the goods we are ordering, 456,000 units, times $1. So coincidentally, it will still be 456,000 units, $456,000. So if this is what we buy, we are supposed to pay in 60 days. So the trade payables at the end of the year will be 60 over 365 times the figure. $456,000. So what do I have? 60 divided by 365 times 456,000. And that is going to be 74,959 approximately. So per the current policy, this will be our trade payables. But then if we take the early settlement discount, then we have to pay within 30 days, and we'll get 1%. So let's work that out after the discount. So trade payables after discount will be Still, you owe the person 456,000, but they will give you a 1% discount. And then the payable days will now be just 30. So 30 over 365. So we punch it out to get a trade payable after the discount. So 30 over 365 times 456,000 times 0.01. And that is, hold up. No, times 0.01 will give me the discount. So we will do 99%. Because times 0.01 will give me the discount. Sorry. So we'll take 99%. 0.99. And that is 37,105. So if we take the discount, then there will be decrease in our payables by how much? So decrease in trade payables. And that is the amount at the top, 74,959 minus 37,105. So our trade payable would decrease by how much? $37,854. Stay with me. So now your trade payable balance is decreasing by this amount. If it is decreasing by this amount, it means you are not getting this money to fund your business. So you have to go borrow this from the bank. So this will then increase your financing. So increase in financing will be the 37,854. What is the annual interest we are paying on the short term? 5% per year. 5%. So if we take the early settlement discount, then we have to borrow this money from the bank, so times 0.05, and that is 1.8, maybe 9.3 approximately. So this is your increase in financing. But how much discount are you getting? So let's calculate the discount. We could call that value of discount. It is 456. And it is just 1% discount that you are getting. So 0.01 times 456,000. And that is 4,560. So you are getting a discount of 4,560. If you take it, your finance cost will increase by just 1,893. So you see that the discount you are getting is more than the financing cost. So the net value, which is the context of the question, it says, calculate the net value in dollars after accepting the early settlement discount. That's the answer to the question. So net value after accepting the discount will be the discount value, 4,560, minus the increase in your interest, 1,893. So it's a good deal, if you ask me. 4,560 minus 1,893, 2,667. This is the answer to the B aspect of the question. Again, get the concept well. We bought 456,000. Currently, per the policy, we are supposed to pay in 60 days. So the trade payables at the end of the year would have been 74,959. However, the supplier is saying that, listen, if you can pay in 30 days, I give you 1% discount. So if we take that deal, then our trade payable will now be just 37,105. It means by taking or accepting the early settlement discount, our trade payable, which is source of funding, has reduced by 37,854. Now, that reduction in trade payable, since trade payable is a source of finance, we need that trade figure from somewhere. So you have to go borrow to finance your working capital. If you borrow, you are paying 1,893. So that is the increase in your financing. But on the overall, you are getting a discount amount of 4,560. Your borrowing is increasing by 1,893. So the net value after accepting the discount is 2,667. That is the idea about trade payables management. And funny enough, that is just one mark, okay? Now, forget about the marks allocation here. I'm interested in your ability to understand the concepts. Okay, so to some extent, don't look at the marks allocation. Just follow the concepts that we are trying to establish here. Then the C aspect said, discuss how, oh no, that's 5 marks. What we just did is 5 marks. So it's fair because, I mean, we are doing a lot of work. Then the C aspect said, discount how invoice discounting and factoring can aid in the management of trade receivables. So when it comes to trade receivables, there are 2 ways we can manage it. So this is a reading aspect. We can do invoice discounting or factoring. Now, what is the difference between the two? Invoice discounting means selling, literally, our trade receivables for an amount below the face value. So, like you owe me, let's say you owe me $10,000. And per our agreement, you are supposed to pay me in 90 days' time. But I cannot wait 90 days' time. So I could go to a discounting house and then they can say that, okay, although the person owes you $10,000, guess what? I will pay you, or someone else, a third party will say they will pay me. That's the discounting house. They will pay me 7,280. Now, so that they will wait till the 90 days, then they can get the money from my supplier. So the difference between the face value and the discounted value will be the cost that I have to incur if I do invoice discounting. And then it will also be the profit to the third party or the discounting house. That's the idea there. That's the idea. So that's the concept of invoice discounting. Then debt factoring is more or less like outsourcing the management of our trade receivables to a third-party organization. So maybe we don't have a number of people, or many people are not paying us on time. Okay, so many of our customers are refusing to pay on time. Okay, since they are refusing to pay on time, but we need our money, let's bring in a third party. So what happens is that the factor comes in and we can arrange. We had debt factoring with recourse, debt factoring without recourse. Okay, so we are with recourse and then without recourse. With recourse means that the entity is liable for any amount that we are not able to recover. Okay, so the entity is still liable to any balance outstanding. In other words, under debt factoring with recourse, the entity bears any risk of unpayment. Okay, so the entity bears any risk of bad debt. That's the idea. Any risk of bad debt. But debt factoring without recourse, here, it is the factor that bears the risk. So the factor is liable to any balance outstanding. So the factor bears the risk for bad debt. Okay, so the factor bears the risk for bad debt. Now, there are some advantages here because when you outsource your trade receivables, it means there are certain costs you will no longer have to incur. Right? The management of that trade receivables, it may reduce how much bad debt you have to incur as an entity. That is also another benefit that may come in. But it will cost you because the factoring agent will charge you a fee. And on top of that, sometimes it depends on the way the deal is arranged. The factory agent may give you upfront money, like a loan, and you have to pay interest on that as well. So in making a decision whether to factor or not to factor, we will compare the benefits, that is the cost savings, if we are not managing receivables again, and the reduction in bad debt, to the cost that we have to incur if the factor agent comes in, and that will be the agency fee, and sometimes plus the loan, the interest we have to pay on the loan that they will give us upfront. Then certainly, either with recourse or without recourse, then we will make the decision. If the net benefit exceeds, if the benefit exceeds the cost, then we factor. But if the benefit is less than the cost, then you don't factor, you continue to manage your own affairs. So when it comes to trade receivable management, these are the things we must understand. Invoice discounting, selling your inventories to get an amount below how much it's worth because you want the money right now. Factoring, outsourcing your receivables to a third-party entity so that that third-party entity takes over the management of your receivables. These are the difference between the two. And so let's look at the debt factoring issue and see how the calculation works like. Give me a moment. Let me bring in my slide on that. Let me look at which question has that debt factoring issue. Okay, so still in this question kit, you go to, I think, question number 3. Yeah, here. On page 6. Question number 3 on page 6. Now, stay with me carefully here. So, this question is about debt factoring. And the reason I jumped to that is because I want us to look at the factoring, the way the calculation works, because we said to determine whether we should factor or not to factor, we look at the difference between what is available, the benefit we will get, and the cost that we will incur. So let's look at it. A. Advise whether the factor or the factor's offer is financially acceptable to Window Co. Is it Window? Window, okay. Window Co. So let's see. Then B says, briefly discuss how creditworthiness of a potential customer can be assessed. We'll come back to that. Let's see. The finance director of Winnow Co. had been looking to improve the company's working capital management. Winnow Co. has revenue from credit sales of $26,750,000 per year. So this is the trade receivables. And although its terms of trade requires all credit to be settled within 40 days, so this is the current trade receivable days, 40. on average, customers have been taking longer. Approximately 1% of credit sales turn into bad debt, which are not recovered. Oh. So, current policy, 40 days. Bad debt, 1%. Trade receivable currently stands at this amount. And Winnoco has a cost of short-term financing of 5%. This is one thing you must understand. If our customers don't pay us on time, then where do we get money to pay for our operating expenses, pay our suppliers? You have to go borrow the money. Because we are talking about working capital management. So you have to go and borrow the money. The finance director is considering a proposal from a factoring company, Nhyira Co., which was invited to tender to manage the sales ledger for Winnoco on a with recourse basis. Okay? With recourse. So it means at the end of the day, the entity will still bear the risks for any bad debt. But that could be beneficial because when a third party is coming in, customers will take us serious a little bit and pay us as soon as possible. Nhyira Co. believes that it can use its expertise to reduce the average receivable days to 35 days. Okay, because currently we are doing 40 days. But the factor agent is saying that they will do the same in 35 days. While cutting bad debt by 70%. So currently we are doing 1% of the receivables going as bad debt, but they say they will cut that by 70%. We'll come back. Reducing the administrative cost by 50,000 per year. This is a cost savings for us. This is a cost savings for us. Now, a condition of the factoring agent is that the company would also advance Winnoco 80% of the value of the invoice raised at an interest rate of 7% per annum. Because nothing is free. Nhyira Co. would charge an annual fee of this amount on the credit sales. Assume that there are 360 days in each year. Okay. So let's break it down. So our current receivables, so current trade receivables is, permit me to put dollar above here, is the 4458. So 4,458,000. That's our current receivables. Now, if the factor is going to come in, they said they would do 35. So let's bring in the receivables if the factor comes in. So revised trade receivables. And that is going to be the annual sales we do on credit, 26,750,000. 26,750,000. Multiply that by the 35 times 360. So you got to be careful here because they've given you the number of days. If the number of days are not given, then we can use the standard 365. But 360 is given here, so we stick to that. So 35 divided by 360 times 26,750,000. And that is 260 or 2,600,000, maybe 694. So if you check, by bringing in the factor, there is going to be a reduction in our receivables. So reduction in trade receivables. How much? 4458, 123. 4458, 123. minus 2,600,694. And that is 1,857,306. 1,857,306. So that is the reduction in our receivables. Okay. So if our receivables will reduce by this amount, then we no longer have to go and borrow money. So now let's look at the benefits of bringing in the factor. So the first benefit will be a reduction in our financing cost. So you don't have to go borrow this money from the bank at, what's the rate? 5% per annum. So our answer, 1,857,306 times our interest. What's our interest? Yeah, 5%. So this will be reduced. So my answer by 0.05, 92,865. What other benefit we will have? The administrative cost of 50,000, we don't have to pay that again. $50,000. Then remember, they said by their presence, they will reduce our bad debt by 70%. So let's get a bad debt and then 70%. So reduction in bad debt. That's a benefit. It means more money you are getting. So your sales is 26,750,000. We are told that 1% of that goes into bad. So 1% of that would have been bad debt, but the factor says they will save us 70% of that. So times 70. Give me a sec. My short is a little. So what do we have? 26,750, 123 by 0.01 by 0.7%. So we will save 187,250. So if the factor comes in, our financing is reducing because trade receivable is reducing by this amount. So this money is coming in from the debtors. Because it's coming in from the debtors, you no longer have to go to the bank to borrow money. So there is a reduction in your financing. Number two, because now the third-party organization is taking in charge or is in charge of your receivables, that administrative cost of 50,000, we are not the ones who are going to go after the debtors again. So we are saving that. Then the factor is saying that now your bad debt is 1%. When I come in, I'm going to save you 70% of that. So that is a benefit to us. So in the context of this question, these will be the benefits on the contract. So plus 50,000, 92,865, and that is 330,000. 115. So 330, 115. But what is the cost? Because this is the benefit of bringing in the factor or the factoring agent, NEFCON. So let's bring in the cost. So cost of the factoring agent. Two things. They say they will charge us a fee of what? Let me clean these so that we get the idea. Fairco will charge an annual fee of 0.75 on credit sales. So we bring in their fee. 26,750,000. They are taking 0.75% of that. That is not a significant amount of money, though. So we punch that out. 0.75. Wow, that's strange. So 0.75 divided by 100 times 26,750,123. And that is 200,000. Whoa, I was thinking it's not going to be money BL. 200,625. So 200,625. Now you got to be careful about this punching because it is 0.75%. So you got to be careful. Now, in addition to this, they will give us some money up front, which we have to pay them an interest. They said they will advance 80% of the money to us, but we have to pay them an interest of 7%. So that will come. So there will be an increase in our financing cost. %, of let me see. Of the receivables figure, which is 2,600,000. Give me a sec. Let me read this thing well. Winscorco will advance 80% of the value of invoices raised. Okay. Value of invoices raised. So 2,600,000, which is the trade receivables now. 694. But you got to be careful. They are giving it to us at an interest rate of 7%. We would have got it at the bank at 5%. So the increment, the extra payment, so this will be times into bracket 7% minus 5%. Okay? So it is the additional finance cost that we are thinking about. The additional finance cost that we are thinking about. So let's build it in. 0.8 by 2,600,000, 694 times 0.02, and that is 41,611. So at the end, the total cost of our agent is 200,625 plus 41,611, and that is 242,236. So if you check, bringing in the agent will cost us this amount, but the benefit we are getting is that amount. So the benefit exceeds the cost. So net benefit is going to be equal to 3,115 minus 242,236. So we punch that out. And that's a net benefit of 879. So that is our answer to the question. Now, should they accept it? Because the question said, advise whether the factors offer is financially acceptable to Windsor. So on the basis of this, the factors offer is financially acceptable, okay, as the benefit exceeds the cost. So, in other words, engage the factor. That's what we are saying here. In other words, engage the factor. Now, you got to be careful here because there are theory aspects of this whole discussion, and that is to look at the limitations of bringing in a factoring agent. Aside the financial issues, there are other issues, right? The reputation of the firm. I owe you. I'm doing business with you. Then all of a sudden, my phone will ring, or I'll get an email, or somebody will visit me at the business premises and say, hey, you owe this person. And so we are now the ones who are coming to collect the debt. I mean, it creates some discomfort. It's like, so you think I won't pay you or what? So it could result into loss of customers, as some people will feel that they've been doing business with you, now you are sort of selling them to another person to take over. So that is something that has to be understood there, but that is the context of our question. That's the answer there. Then the final part is the B aspect of the question. It says, briefly discuss how the credit worthiness of potential customers can be assessed. Now, there are various ways that we can assess credit worthiness of customers before we sell to them on credit. Certainly, you want reference. Okay? So, reference from their previous places of doing business. We'll be interested in that. Number two, we can also use credit rating agencies to assess the credit worthiness of a customer. So if the details of the customer is in the rating agency, then we can assess the risk profile of the customer in respect of that. So credit rating can be used in that regard. And normally this will be for large companies that we are looking at. Another thing will be, give me a sec. Let me see if I will get another point here. From my slide, if I can bring up another point. Okay. And then sometimes we can talk about, press releases or industry reports. Press releases or industry reports. That can also be used because the press releases and reports going on can give us an idea, give us a clue on exactly what is happening within the industry. So these are some of the ways that we can assess the credit worthiness of customers. And that is what you must understand when we talk about trade receivables management. So let me come back here for plot go. Slide 1 there. And then slide 2. Slide 3. Slide 4. Slide 5. Slide 6. Then the receivables discussion. Then the last question on the management of the trade receivables. So under working capital, we've looked at inventories, we've looked at trade payables, and then the receivables management, the final slide. So 15 marks area. So we are left with, even under the inventory, there is one more thing left. That is the working capital, the cash operating cycle, okay, or the working capital cycle. Then we can go to the cash management, where we can use the cash issue, or we can use the Miller or model to determine how we can manage our cash. So that is it about that. I'm going to be wrapping up around here today, and then we will continue in our next session as we see the next few things we will get into. So in the next session, we'll look at some other issues still under the working capital, crystallizing the principles. Then we will jump on into the issue in respect of investment appraisal. Then I will come back in with some of those theory written areas in respect of PFA, and then public procurement as we continue with the discussion.